Okay, guys, welcome. We'll get started. I want to thank all of you for coming. I know it makes for a long day to segue right from the 4:15 futures close, or even if you're just a cash trader, the 4 o'clock close into an event at 4:30. But I think this will be worth your while. And we're going to talk about day trading today, but really the topic of day trading is you really can't separate it out from any type of trading that you do, and you're going to see that. And that's the good news, is that the same techniques that we teach our clients to use to trade in a day-to-day time frame or swing trade are the exact same techniques that you use to day trade. One thing that I want to start with, you see the chart of the S&P. Now this is through today's close, and it is fascinating, at least for me, and I've been doing this a really long time, and it continues to be fascinating to watch how a market develops along these auction market concepts so incredibly consistently. There's all sorts of things going on in the world. We have elections, we have world economies going this way or that way, and currency wars, and the Fed doing or not doing things. But the auction market chugs along and develops following the same exact patterns of development that auction markets have always followed since the beginning of time. I always say this in my webinars, but it's true, and it bears repeating. I will occasionally have someone ask me, well, what do you think about X? In other words, what do you think about the negative interest rate policy that the Japanese just instituted? Well, it's just noise to me. If I'm trading the Japanese yen, it certainly created short-term volatility in the yen, but the yen from this level following that news will once again, because it trades in an auction market, follow the precepts of how an auction market forms and what an auction market does. And it will basically follow this pattern of constant transition from balance to imbalance, balance to imbalance in all degrees of time. So this is a remarkably robust methodology, and in times of trouble and turmoil in the markets, and if you're a trader, I defy you to name a period of calmness. I've been trading now for over 30 years, and it's always been something. There's all the media and is always focused on something that the market is going to react to, or might react to, or should react to, and that's just the way it is. And I have gotten to the point where I ignore it. And I don't have trouble ignoring it anymore. I mean, obviously I'll read the newspaper, but I no longer think in terms of, oh, wow, if Hillary gets elected, what's the market going to do? Or if Trump gets elected, what's the market going to do? I don't know. I don't care, because the information that I need to trade is the same information that I had available to me 30 years ago when I first started trading, and it's timeless. So, in times like this, those of you that have gotten to the point where you're immersed in these concepts, and I'm going to talk to the rest of you today about how you can do that, it's a much, much, much more relaxed way to trade, because you become your own expert, and you're not dependent on outside noise and exogenous events and cable news to make trade decisions. It's really something just very separate from your business, your trading business. Now, you can see the development here. There is an incredible resource we have on the website that happens to be free. So go to Alexander Trading, you can go to blog, and every weekend now I am updating the stock indices. I am basically updating the charts and the key reference areas for the ES, the Spider, the NASDAQ, the Qs, the Russell, the IWM, the YM, and the Diamond. So I'm covering the 4 primary trading indices, futures contracts, and their respective ETF proxies. So you can click on the chart and it enlarges the chart. But the cool thing about this is that you can go back. You can go back to previous weeks in the blog and you can see what I was saying back. This was a special update when the market was really tanking back on the 20th of January. And this is a monthly ES. And I said, these are my comments. And this was the key reference area that I had highlighted at that point in time. And then you can go to your charts. Now this is a daily, but let's just go to monthly. I'll have to make it a continuous contract. Voila. And you can go back and you can see what happened based on what I thought was going to happen based on applying auction market concepts. And it's basically a weekly trade lesson in how to apply these concepts, guys. I want to go back to so this is going to be, we're going to use some examples later in the webinar from trading from these levels, but the levels that you see, the key reference areas are the cornerstone of trade identification under this methodology, and we'll talk more about that in a little bit later. Yes, somebody asked, is this being recorded? The answer is yes, it is being recorded. Okay, effective day trading using auction market concepts. Now, most of you are aware of who I am, but for those of you who may not, here it is. There is additional information about me on the website, and I encourage you to go check that out if you're interested in more detail about who I am and my background. The other piece of information that you need to be aware of, obviously, is that trading is risky, and it really, truly is risky. And it is made even riskier if you are trading real money and you have no evidence whatsoever that you have a positive expectancy. It baffles me how people who would not think about gambling away their money or would look at gambling as merely entertainment and they're going to risk X amount of dollars will get into trading, not know how to trade, have no proof whatsoever that they know what they're doing, and put substantial amounts of real money in play. It's just foolish. And if you're doing that, if you don't have some evidence that you have a positive expectancy, you're going to lose all your money. So you may as well understand that up front, and you've got two choices. You can develop a trade plan that has a positive expectancy, and you can test that trade plan and give yourself at least the best evidence available prior to putting money on the line that you should, over a series of a number of statistically valid trades, have a positive outcome. Or B, just assume that the money that you're trading is the cost of tuition for learning to trade, because whatever amount it is, I don't care if it's $1 million or if it's $10,000, if you don't know how to trade, you haven't proven that you know how to trade, you will lose that money. And I have had clients, more than one, that have lost 7 figures trading because they didn't know what they're doing. So it's not unusual. It's very, very common. So here are some of the things we're going to cover today, some of the major pitfalls of almost all day traders. Why what I'm going to show you can be the most profitable way to day trade, and why it's different, how it's different, why it's a superior approach to day trading. I'm going to give you some examples and some case studies. And of course, I'm going to give you guys can type in questions, and I will try and make note as we go along and answer your questions as well, obviously. By the way, I apologize to those of you that had signed up and had expected me to present this webinar last week. I just came down with an awful cold. I am almost fully recovered. I have some remnants you will unfortunately probably experience during today's presentation, but I'm out of the woods, let's put it that way. I did not feel well for a couple of days. Now we're going to talk about using the market profile graph. We're going to show some market profile graphs. We're going to show some bar charts. It's important that you know, when you Google market profile, Alexander Trading may come up, Tom Alexander may come up, but we're not market profile traders. We're auction market traders. You don't want to be a market profile trader. You want to be an auction market trader. You don't need a lot of stuff, extra stuff on charts and extra charting and super secret special software, indicators. All of these things are not going to help you trade. What you need to learn to do is to understand the market and how it works. If you do that, then everything that you need comes in any basic charting package. So the most powerful thing you can do to maximize your potential as a trader is to learn how an auction market functions. It can give you an edge in any time frame you choose to trade, whether it's the day time frame or it's a longer term time frame. And the good news is that day trading and what you're looking for in a day trade is no different than what you're looking for in any other time frame. It's just in a different time frame. So you can develop a trade plan that can give you an edge to day trade any market. Now, most of the examples that I have today are in the ES. If there are other contracts you want me to show, we may look at that. I may make it a point to show you some other contracts. Show the ES because it's sort of the common denominator among traders and especially day traders. And if anything, I think day traders fixate too much on the stock indices. You guys have heard me say this. If you take the ES all the trading days of the year and average it out, it's probably one of the worst contracts to day trade. Now, it just so happens that the last few days it's been quite good, but and I'll get into this a little bit more later. Even if you are a day trader, one of the easiest ways you can improve your trading, besides learning these techniques, is to understand that you're looking for opportunity, and it might not be in the ES. It might be in the Japanese yen, gold, crude, corn, beans, some other contract. What we're doing, excuse me, when we look at a chart, a bar chart or a market profile chart, we want to identify market condition. You hear me discuss and use the term auction markets, and an auction market has at any given point in time is in a market condition, and it's basically in balance or it's in imbalance, and we're trying to identify the market condition by using our charts, our bar charts or our market profile charts, and that's all you need to enable you to do this. Now, the overwhelming majority of price activity is noise. Traders, for some reason, have a difficult time grasping this undeniable fact. Most market activity is basically random rotation up and down that's meaningless in terms of any sort of directional tell. It's probing, it's trade facilitation. It's the natural, normal state of an auction market doing what it's designed to do, and that's facilitate trade. And this is why price-based trading, which is characterized by reliance on indicators, all this overbought and oversold stuff and oscillators. It does not work. And the other thing about price-based trading, especially day trading, it usually involves trading one-to-one or worse. And you do realize, hopefully, if you're risking one to make one, you're really not making one because you're paying the bid-ask spread and you're paying commissions. So you have a negative expectancy going in. You cannot make money that way. All right, wait a minute. I've got some comments here. Let me go back up here real quick. I want to catch up. Let's see. The webinar is recorded. How do you treat past high volume nodes with special reference to the ES and the daily time frame? Question is respective, blah, 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 blah. Let's see. Yes, we're going to talk about that. Just wondering if you put significance to past high volume nodes. Yeah, I'm going to talk about. I'm going to cover that. Let's see. The trouble I've seen with market profile auction trading, it doesn't seem to present real entry-exit methods. This is a common complaint among many people. Okay, we'll talk about that. Do I use breadth into intraday to further confirm my decisions? The short answer to that is yes, Alicio, but I'm not going to get into that a whole lot today. That's a topic, and it's going to be a webinar for another time. I'm going to do a separate webinar just on using breadth. Okay. This is typically what your intraday trader is doing. They're in here scalping in and out all day long, making trade decisions that have really no logical basis, no consistent basis. It's just a feel or an oscillator's at the top of its range or the bottom of its range. That doesn't work. It has never worked. It will never work. I have been trading 30 years. I have seen dozens and dozens and dozens, if not hundreds of people that have day traded to various degrees of success. I have never, not once, met a day trader that has sustained long-term success. I'm sure somebody's out there that has, but they're rare. And if there is someone, they can't teach you what they do. I promise you that. So the keys to effective day trading, there's several keys. We have to understand that not all prices are alike and that the majority of price activity is random. Something else that is grossly underestimated in terms of importance. It's not doing anything. Your job as a trader most of the time involves not trading. You have to be selective. And we're talking about day trading here. I'm not talking about position trading. You need to have a reason to be selective, a basis. And that's why most people have such a hard time with patience and discipline. They had no basis for it. Well, this is a methodology that provides that basis because you know why you're waiting. Most traders don't know why they're in the market and they don't know why they're out of the market. So they're anxious if they're in the market and they're anxious if they're out of the market. Something else, you have to be different to succeed in this business. Most people do not succeed in this business for a variety of reasons. And if the majority of traders are losing money, why do you want to go find out what they're doing and try to copy it? It just doesn't make sense. There is a learning curve in trading. It can be shortened, but it cannot be eliminated. There's no magic secret. You know, trading is a very worthy profession, a very worthy endeavor, and you can do very, very well in trading. but you cannot expect to do very, very well in trading in a few weeks and doubtfully in a few months. I'm sorry, it just doesn't work that way. And I have a lot of people that will periodically, well, I've been trading for 6 years. But the reality is they haven't been trading for 6 years. What they've been doing is trading for a year at a time, trying something new for 6 different years. That's not getting you anywhere. You're just basically chasing your tail over and over, looking for the magic. Because as an industry, the trading education industry is built on magic. It's built on secrets, the secrets of floor traders, the secret that helped me make $1 million and all this nonsense. There is no magic secret in trading. Trading, like other professions, requires valid information, hard work, study, and experience. What does work? Trade only from key reference areas. Trade from where there is a higher probability than randomness that an outsized move relative to the time frame you are trading may occur. If you do this, you will have a consistently favorable reward to risk opportunity, and you will end up with a positive expectancy. The easiest way to end up with a positive expectancy is to have outsized winners relative to your losers. I often try to get people to understand this by using the example that so many of us have experienced at one point or time or another in our trading careers, where you're trading and you put on a trade and you get stopped out. And then the market comes right back to where you entered, or it even goes in the direction you thought it would go. And you got stopped out. So you put on another trade. Well, you get stopped out again. And what happens? Well, the market comes back to where you got in, or it goes in the direction that you had originally intended. But you put your stop in, and so you do. So you do this, and you do this 10 straight times. And every single time, the market stops you out, and then it comes back to where you could have gotten out at break even, or it even went in your direction. So that 11th time, you say, well, they're not going to get me this time. I'm not going to use a stop, because the market always comes back to where I got in. At least, if it goes a little bit more than I thought it might, then I'm just going to let it go, and it'll come back. Well, it goes, and it takes out the level that you would have put a stop, but you didn't put a stop in because you've learned now and you're smarter than the market. But it keeps going. So you sit there, well, yeah, okay, but they're not going to get me this time. And it keeps going. So now it's really, really overbought or oversold. So you say, well, it can't go any further than this. So I'm going to put another contract on here. Market pauses a little bit, takes off again against you. And this goes on and on and on for hours, or in some cases, depending on the time frame you trade, for days. And ultimately what happens is it wipes out your entire account, or it wipes out the entire previous 30 days of gains that you worked hard for. Now, this has happened to me, and this has happened to almost every single trader I know that's been trading for any length of time. Now, let's flip this scenario around. Now, that's a random situation. So let's assume we're actually trying to put ourselves in that situation. But on the mirror side of that, where we put on a trade and we put in a stop, and as soon as it goes, instead of as soon as it goes 2 points in our direction, we're so giddy with excitement, we take a 2-point gain that we let it go. Well, guess what happens? 7 or 8 times out of 10, it comes back and it stops us out at break even, doesn't it? But what happens at 10th or 11th or 12th time? It takes off and it doesn't look back. So I'm telling you, if you've got to think differently when you're trading this methodology, and it does take some conditioning. I will never tell you that any type of trading is easy, and I'm not going to tell you that trading this way is easy. I understand the fortitude and the reconditioning that it takes when you are learning to reorient yourself towards getting that outsized gain. But it's there to be had. And it's unavoidable if you will let your profits run. And this gives you a basis for letting your profits run. And it goes even further than that. It gives you a basis for where to enter trades from where it is most likely that a profit is going to run. This is the best way to trade. In the long run, once you condition yourself and you understand this, it's the easiest way to trade. We're always focusing on market condition. Market condition is our holy grail. Market condition is our indicator. It dictates when, where, and why to trade. It helps us to determine whether or not we have that opportunity that gives us a multiple potential return versus the risk that we have to assume to take the trade. So market condition alerts us when, where, and why to trade. And just as importantly, maybe even more importantly, it defines when, where, and why not to trade. So this addresses that issue that traders struggle with of, I don't know when to be in the market. I'm nervous if I'm in the market. I'm nervous if I'm out of the market. You know, you would think from all the trading psychology stuff that traders are just a complete whacked out bunch. Well, that's not the case. You know, if you don't have a basis for understanding what you're doing and you're trying to do it, naturally you're going to be nervous about it, right? So any trade, a day trade or any time frame trade, should be taken only if it is reasonably and objectively determined that the potential reward of the trade is a multiple of the initial risk of the trade. Now, this rule eliminates scalping, which can't be taught or successfully maintained over any significant time frame. Now, it's very popular to encourage people to scalp, you know, especially the Forex traders want to try and scalp everything. But if you are a Forex trader, there is no better way to trade than what you're seeing here. This works beautifully in Forex. You can't tell the difference between the Japanese yen, US dollar cross as you can the Japanese yen futures contract in the U.S. It's the moves are the same. So what if there were something that could give you the information that all the indicators purport to provide us, that gives us that information about when there's a greater random time and place to put on a trade where we are going more likely than not to get an outsized move? That would be a very cool, powerful thing, right? Well, let's look at indicators. Now, indicators are trying to tell us or purport to tell us when a market is overbought, oversold, when there's likely to be a trend change. Now, the reality is overbought and oversold don't exist. And the indicator world implies that once a market is overbought, it's going to turn around on a dime and it's going to scream in the other direction in a straight line. And when it gets oversold, it's going to turn around on a dime and it's going to scream in the other direction. And that's just not the way things work. You know, if you've tried this stuff, you have to admit that. Indicators purport to tell us where to sell, buy, and then when to sell, buy back. Does it work? No, it doesn't work. Now, as I've always challenged in these webinars, and I've been doing this for 20 years. Actually, I've been the trading educator for 11 years, but as long as I have worked with traders, I've always challenged them to challenge me. And if what you're doing works, by all means, ignore everything that I'm telling you and keep using it. And if you can prove me wrong about anything that I'm saying in this webinar, you're doing me and the public a huge favor to let me know, because I do want to know. If you have evidence that something that I'm saying in here is not true, I want to know. So indicators are a crude attempt to identify, again, market condition conducive to executing profitable trade entries and exits. Have you ever heard anyone that promotes the use of indicators use the term expectancy? You have to have a positive expectancy to trade profitably. You have to have a positive expectancy to day trade profitably. The entire emphasis of an auction market trader is on identifying this positive expectancy in their trading. It's a very, very different orientation towards trading. Very, very different. Now I want to spend some time, and I didn't put this in the description of the webinar, but when you're talking about day trading, this is something that has to be discussed. Does anybody have an idea what the giant elephant in the room of day traders refers to? Any guesses? Too much size? No. Patience? No. Ourselves? Well, that's a good one, but no, that's not it. Overtrading, chop. Chop is closest so far. Big money. Now we're getting close. Chop and big money. Okay, we have two different entries. Those are hints. Chop and big money. Random, that's another part of the equation. Chop, big money, and random. Ah, Robert, you nailed it. You nailed it. HFT. What is HFT? High frequency trading. So this changed the trading world, especially the day trading world. And high frequency trading is the domain of large, extremely well capitalized institutions that have dozens of math PhDs from MIT and Stanford and these places using complex algorithms and technology to trade sub-minute price fluctuations. And basically what high-frequency trading is doing, they're using regression strategies to game the price discovery process of an auction market. High-frequency trading is responsible for a tremendous amount of the volume in the stock index futures contracts. It is on one side or the other of the majority of ES trades every day. Now, when I first started trading back in the mid-1980s all the way through, I don't know, the mid to late 1990s, you could day trade easier than you can today. The moves were smoother. You tended to have intraday trends more often. Every single price wasn't contested. That's not the case anymore. It is now almost impossible to scalp very short-term time frames, 1 to 3 minutes or less. And this has always been a fact. You are not decreasing your risk, your day trading risk, by going lower in time frame. You increase your risk by trading very short-term time frames. You increase the probability you're going to lose your money by going down in time frame. Now that's counterintuitive because the big attraction that is sold to day traders or used to sell day traders is, oh wow, if you're day trading, you don't have as much risk. You're going home flat every night. You have to worry about this, that, and the other. That's nonsense. So high frequency trading has to be factored into your understanding of the day trade time frame. Now I want to talk about something else that I did not put in the description. I'll talk about volume because it sort of ties in with high frequency trading, and I get a lot of questions. Do you use a volume profile or do you use some of the volume indicators that indicate delta, the amount of selling or the amount of buying in a given time frame? So this is a discussion of that. Now, most volume is non-directional as well, and certainly high-frequency trading is a substantial part of volume, and it is most certainly non-directional. Now, the other thing about volume that people don't understand, if you're trading the ES, and there's a lot of volume in the ES, that volume a lot of times is just part of a much more complex, larger trade. It's a trade that might involve the ES and the S&P 500 cash. It could involve the ES and the Russell cash, or the Russell futures, or the NASDAQ, or any number of different contracts. So volume is not directional, not necessarily directional. You can't get an edge this way. This is sold as magic. And as I have said many times, magic does work spectacularly well. Without exception, if you're using magic to trade, your account will disappear. Now, the overwhelming majority of price activity is noise. We've already established that. Those of you that trade intraday should have an intuitive feel for that fact. It's the normal, natural state of an auction market doing what it's designed to do, and that's facilitate trade. And it's why price-based trading, this reliance on indicators, doesn't work, and it's why you can't develop a trade plan with a positive expectancy, because it involves trading one-to-one or worse. So if volume drives price and the majority of price activity is random, then the majority of volume is what? It's random, right? Now, this was an article from 2 or 3 years ago, and I quote it extensively in the following slides, but there's some great information in here. And this was a study of high-frequency trading by the chief economist of the CFTC and researchers at Princeton and the University of Washington. So they took actual trading data from individual firms, and they came to a number of different conclusions. What that data does is help explain the frenzy in today's markets. The most aggressive firms tend to earn the biggest profits, hence the incentive to trade as quickly and as often as possible. Furthermore, these traders make their money at the expense of everyone else, including less aggressive high-frequency traders. The study found that the most hyperactive trading firms earned an average daily profit of about $400,000 in the E-mini over a 2-year period. First and foremost, among those on the losing end, shocking, huh? Small retail traders. So these big firms that are making an average daily profit of $400,000 a day, and this was a few years ago, the big loser is the small retail investor. And I don't care how large your account is, you qualify as a small retail investor. You and me both. Now, this is still quoting from this. A big puzzle, though, is why these small investors lost it all. One high-frequency trading technique is to use computer-powered algorithms to glean the investing patterns of other traders, whether mutual firms, securities firms, trading for their own accounts. High-frequency traders can use this information to execute profitable trades. But small investors usually don't have a discernible strategy. So here you have you and me in here trading noise against high-powered, highly capitalized firms with extraordinarily sophisticated, detailed strategies, but we're just sort of winging it, and we think we're going to make money. And I wonder why we lose. So maybe it's more because of a lack of a discernible strategy than HFT that's the biggest problem among day traders. But if you add the no discernible strategy that most retail traders bring into the market with high frequency trading, you're just not very smart if you think you can win that game. So high frequency trading is this constant back and forth churn designed specifically to sweep small ranges. You can't win that game. You cannot scalp inside of the range of day extremes with the 3, 4, 5 tick stop and beat that. You cannot do it. Now, on the other hand, you can't lose a game you're not playing, so don't play that game. You have to play a different game, and you have to have a discernible strategy. It can't be this one, but you certainly better have one. So what does work? Well, we're going to talk about some things that can get you out of that noise so that when you trade, you're putting the expectancy on your side and you're not just going to and fro with everybody else against the high frequency traders. You cannot fight that. You want to trade conviction. You want to go with, not against, the outsized wide range move. Now, this is counterintuitive to a lot of day traders. Most day traders seem to want to fade everything, and it gets back to the regression thing. Most of the time, price comes back to where it is that you got in, right? Well, you want to go with conviction. Conviction is your greatest hope in terms of positive expectancy. There's only one party in the market that can create and sustain a trend. It's the big money, and you do not want to be in their way, and you want to go with them. You want to ride on their back. You've got to make your trading simpler. The less you use for decision, the quicker and more confidently you can make that decision. Now, you want to put time on your side as a trader, and that includes the intraday time frame. It is impractical to think that you can sit there and make good decisions every day, all day long, if you're making a lot of decisions. It's just not going to happen. You cannot sustain that type of focus day in and day out, year after year. It's just not going to happen. So simplify your trading and define your trading. You have to have that discernible strategy. Learn what really matters and what doesn't. And when the market is trading and it's not in an obvious level, you sit there and you watch, or you go find another contract and look and see where it is. You know, if I'm day trading, I'm going to be looking at 2 or 3 different contracts that I've identified the night before that closed at, in, or near good trade location. And this is something else. There's no such thing as certitude in trading. You're always going to be operating under incomplete information. And this is another reason it's so important to focus on having the outsized winning trade. So let's define day trading quickly. It's open. It's nothing more than this. It's opening and closing your trades in the same session. It doesn't mean that you're scalping in and out all day long. Scalping is a subset of day trading. This is not about scalping. Have I made that clear yet? Scalping is this frenetic in and out trading, usually in one contract. Now, this is something that a lot of traders don't want to hear, but it's reality. On a good day, there are seldom more than 2 or 3 well-defined, valid trade opportunities in a given contract. There are many days when there are no well-defined, legitimate day trade opportunities in a given contract. So if you want more consistent opportunity on a day-to-day basis, what do? You follow more contracts. You know, if somebody said, Tom, you can't ever take another trade except a day trade, then what I would do is sit down and I would have 4 or 5 contracts that I would follow consistently. I would follow maybe one of the stock index futures. I would follow crude. I'd keep an eye on the grains and maybe the euro. I just look at those 4 contracts, and I would trade the one that would set up that seemed to be setting up the best on a day-to-day time frame. But you're well served to learn to trade opportunistically, and never, ever, ever forget, not trading is trading. Some of the best trading you can do, some of the best day trading you can do is when you learn not to trade. If you sit there all day long following your 2 or 3 contracts that you're looking at and you don't take a trade, you should feel really good about yourself if you know what you're doing, because you did your job. Your job isn't to trade in and out all day long, create transactions. It's to look for opportunity. Now, if you trade this way, there's plenty of opportunity. I promise that. It's not like you're going to be trading twice a week. So let's define some day trading rules. Let me get caught up here. 1 second. Oops. Okay. If a market is in balance, now I'm not going through and giving you the definitions of the terms that we use. I have done so many webinars that are all over the place. We have a YouTube channel. We have a free course. So if you're not familiar with these rules, go to our YouTube channel, look at past webinars. I'm going to put this on YouTube as well. And you can, if you don't know what balance is, go find out. Trade only from KRAs, key reference areas, or from very near the high volume node. Use conviction as a directional tell and as a trade trigger. You want to make time your friend, not your enemy. If I am day trading, and let's say I'm day trading the S&P Mini, well, after about 3 o'clock, I've got to have a really good reason to enter a trade. Why? Well, I only have an hour and 15 minutes of the day. I have a smaller fraction of the day left for that trade to work. And since I am looking for an outsized gain, I'm risking X to make a multiple of X. I have to have very good reason that multiple of what my risk is can be realized. Now, at times it will be. I won't hesitate to take a trade at 3:30 under the right condition. But I do have to be aware of that. The ideal day trade, on the other hand, to use the same contract as an example, is a trade that occurs between 9:30 and 10 o'clock. Why? Because then I have the potential for catching the entire range of the day. So you want to make time your friend, not your enemy. And you want to be aware of the time in that regard. When you're day trading, you're trading time as much as you are price. Now, if a market is in vertical development, a trend, I only want to trade in the direction of the primary trend, and I want to use conviction and minor balance areas to identify short-term trade opportunity. Do not trade one-to-one or worse. If you do this, you're scalping. Just say no. Just get up, go work out, come back the next day. Do not trade one-to-one. You will lose all your money. You cannot sustain profitability scalping one-to-one or worse. You cannot do it. Do not sell or buy spikes. This flies in the face of an understanding of how a market develops. If a market is up on a spike or down on a spike, the odds are that level will be tested and or there will be development around that level. So do not sell spikes, do not buy spikes. I want to stop for just a minute, and I want to share with you something that we're doing now. What's the best way to learn these techniques? Well, it's basically total immersion. You want to commit to changing the way you trade with both feet. In other words, don't have one foot in this and one foot out. Get access to material and traders that can show you how to do this. We offer a one-year course to thoroughly learn this methodology, its logical basis, how to apply it, how to develop a trade plan with a positive expectancy. It's a 12-month program that's $147 a month. Now you get a weekly sequential trade course. Each week is a lesson, a new lesson that builds on itself. I'm also writing a book as we go along here. At the end of the 52 weeks, you're going to have a book that's several hundred pages long, as well as continued access to the video reports that comprise the course in a sequential manner week to week. I do a daily market report. The daily market reports highlight key reference areas and give general guidelines in terms of direction. I also try to point out the markets that are offering the best opportunity the next day. So that comes every single night. These turn into mini trade lessons. I also do, in addition to this, periodic trade lessons that are archived in your library, and as a member you have your own library. We do monthly member webinars where, similar to this, the webinar is held entirely for you to ask questions. It's an open forum. And then we have a member forum, and the member forum is a live day-to-day forum of people who are trading this methodology. There is a broad range of experience in there. I have clients that have been with me for many, many years that are participating in these forums. And then I have clients that are newer, that have just enrolled in our 12-month program. It is a wonderful opportunity for you to interact among yourselves and to ask questions, not just of me, but of people who have been in your shoes and who are learning and are applying this methodology and have made it and are making it work for them. It's an incredible opportunity. Now I'll show you where you can find this on the website. Go to the website, go to training, click on 12-month membership, and there's more information than I just gave you right here. Here's a video talking about it. Here's a summary. All the details are in here. Okay? So check that out. Okay. Opportunity Recognition 101. This is our quote-unquote indicator. This is what we're looking for. When we see this Gaussian-like shape of a profile graph, we're looking for these three areas, primarily areas. These are your three primary key reference areas from where we expect the market to move more sharply than random. This is a bar chart. This depicts the profile chart. Here are the key reference areas. Now this is obviously the S&P. This is your upper key reference area. This is your high volume node. This is your lower key reference area. We've got a buying tail down here. This level was identified prior to price reaching it. And again, this is something you can catch up with and you can follow in the blog. Now this is the 30-minute ES, and this was today. So this is your larger degree context, and that's something else you've got to have as a day trader. You have to have a larger degree, larger time frame context than the time frame you're trading. I don't recommend that anyone go lower than a 5-minute time frame, and I think the best time frame for day trading, frankly, is a 30-minute time frame. This is a 30-minute bar chart. Now this, pardon me, this was today. We're going to look at some charts in a minute, but you can see the minor balance areas that formed, and you can see the conviction, and this is today on these charts. You have this minor, here's conviction to the downside, you formed a balance area, this happened to break to the upside, then it was down, basically down all day long. So this was that area highlighted here. So the market is trading down from this level. So if the market reached this level, I might have a logical reason to be biased to the short side of this market today, right? If I'm biased to the short side of the market, then I'm not looking to trade. I'm not looking for opportunities on both sides of the market. I'm only looking for short trade opportunities. Now, why would I do that? Well, it gives me focus and it gives me definition. Well, what if I'm wrong and the market goes up? Well, then I'm going to miss the opportunity, probably, to make money today in this particular contract because I came in with a downside bias. But what I'm not going to do is, which is what happens to most traders, they come into the day and they're sort of wishy-washy. Well, is it going up or going down? I might take a short, I might take a long, and I take some longs and I take some shorts, and I have no real direction, I have no real plan. And you end up getting chopped to pieces by trying to figure out what's the primary trend of the market today. If I'm wrong about the trend, I'm going to step back and I'm not going to fight what's going on. If I'm a day trader, the worst thing in the world I want to do is have 3 or 4 or 5 losing trades and keep, as I used to say, be stuck on stupid, trying to pound a square peg in a round hole all day long. If the market is going straight up, I don't want to be taking short trades, but I'm not going to lose money that way. I'm just going to lose opportunity. There's an infinite amount of opportunity. I have a very finite amount of money, as do you. So what I'm looking for on these charts as a day trade, it is the exact same thing that I'm looking for when I am position trading. I'm looking for balance areas. Balance areas give me the key reference areas that help me identify trade location. Now I'm going to go to the charts in just a minute. I'm going to show you a couple of other things too. Let me get through these. So this is what we're looking for. And this is basically, here are your balance areas that form on this chart. So when we see this, it equals opportunity. And then we further affirm that this is opportunity, having done our homework and understanding the bigger context in which this is actually occurring. That's what gives you the confidence to take the trades. Now let me show you, let's go to some charts. Let's see, 30-minute time frame. Now somebody asked about targets before and the fact that market profile doesn't give you targets. Well, I really disagree with that, because if you're using your bigger picture for context, this area in here was a target coming out of this structure down here. This now really is a target for what's occurring now. And intraday, if I'm a day trader, I am cognizant of the typical 10-day and 5-day average true range of the contract that I'm trading, A. And B, I'm also aware that if I am in a balance area, the break from that balance area is almost always 2-to-1, 3-to-1 at a minimum, the width of that balance area, just as a general guideline. Let me show you. Excuse me. My voice is getting a workout. So what I have done here I've taken the fib tool and made it and turned it into something actually useful. So if I identify, let's say this structure right here, somewhere in here, let's say I want to be short. Well, the question I have, if this is a trade I'm going to take, where's my risk? Well, if I enter anywhere in this structure, let's say that I'm going to enter here, then my risk is to here. No, I did it backwards. Hold on. So my risk is to here. I enter here. And then this is 1 times my risk, 2 times my risk. This is 3 times my risk. So if I had taken the most adverse entry I could have taken with the maximum amount of stop under that adverse entry, this trade went to almost 3 times my risk. That's a great day trade. Now, would I have held that trade? Well, I don't know. I did not take this trade. But that's a question that each of you can answer by keeping your trade records. On a day like today, that's something else, understanding the time you enter the trade. If this is early in the day and I get good trade location, I'm likely to hold this contract even though it retraces. Because what am I expecting? I'm expecting something resembling average true range. Here's another trade, potential trade, if I didn't take that one. Keep doing this the wrong way. Here we go. Got to do the stop first, the entry, and then once again, this is my risk. This is 1 time my risk, 2 times my risk, 3 times my risk. This is the type of thing you're looking for. I'm not inside of here trying to scalp in and out all day long. Let's see if I had any questions. So do you guys understand what I'm doing here? Now, if I have a trade, if I'm day trading and I have a trade that goes even 1 in my direction, I'm not going to take a loss on that trade. I'm going to go to break even. If it goes 2 times my initial risk, depending on the level it reaches, I might take a partial profit. If it goes 3, I'm certainly taking a partial profit. But that's getting into money management. Money management and trade management are really different issues than identifying what we're doing today, which is identifying the trade opportunity. But you do want to focus on having that potential for an outsized return relative to the risk you're taking. How quickly can you know you have a trending day versus balanced day? There's no way to know. I mean, there's no way to know in advance. Except for you can be anticipating when you have a market that is coiled up like this. Let me go back to a profile chart. Like this, okay? When you have a balance area that's formed like this, you're looking for the proverbial sharp move. So the move out of this is likely to be a trending day. That's what we mean by market condition. So when you're trading a structure like this, you guys that are clients hear me say this all the time. You want to look for trades on the price side of the high volume node using conviction as your directional tell. So if a market is breaking out of a balance area, then that has good potential to be a strong trade. Now, coming into tomorrow, I'll be a little bit surprised if we exceed this area in here by much until we get some sort of pushback. some sort of balance form in here. This is a great candidate to see how this rally is going to hold, or if we're going right back to new lows. So I would anticipate coming into, based on the information as of the close, I would anticipate a more rotational day tomorrow based on the fact that we've reached this previous volume on the horizontal scale. And again, all of these concepts are covered in the 12-month training membership. All of this stuff is covered over and over and over and alluded to in the daily reports, the sequential trade lessons that occur every weekend, the trade lessons that support that work, the member webinars, etc. All of these concepts are covered in the training membership. Let's look at, I don't know, crude just for fun. All right, here we go. Now crude, this is what is known as a false breakout trade, and we talked about that in the pre-market report for last night coming into today, that this could be a false breakout trade. That's a very specific type of trade. So if I came into today under that assumption, I'm certainly looking for short trades. Now, this is a 30-minute chart, if I'm looking at this, there's no great, nice box, pristine entry here. But if you also notice, all the conviction here is to the downside. Your conviction trades are down. That's your directional tell. This is why you don't buy spikes or sell spikes. You don't sell this, you don't buy this. If I were to take a trade here, I would sell this against this high. These levels are almost always tested. Do I think it's essential to have the market profile package in order to trade as an auction trader? Meyer, do I think it's essential? I guess the short answer is no. I think it's worth every penny that you pay to get market profile. It's not that much money. It's a great tool. Will this work with stocks like Google? Yes, it will work. Excuse me. Will work with any stock. But if I'm trading stocks, I'm certainly looking at a longer term time frame. Stocks are really difficult day trade vehicles, guys, in my view. There's just way too much noise. I mean, the move here occurred in the first half hour. The market was up, but if you tried to buy it, you probably lost money. George, you can get market profile data. I mean, if you have market profile charting package, you can, excuse me, you can, this is crude. Here's Google, market profile chart of Google. Here's the daily chart. I mean, you know, it's an auction market. Aussie. Yeah, you've got a balance area that's formed in the Australian dollar. We talked about this contract this morning as well. Euro. Euro is in a balance area. We talked about this one this morning as well. Now, based on the information at hand, this is a contract. This is a balance area. This is a high volume node. You want to be on the price side of the high volume node. So based on this, I would want to be favoring long trades against a day session low. What's the difference between market profile and volume profile? Market profile is based on this letter concept. TPO's volume is based on the volume profile is based on volume. There's some major problems trying to use a volume profile, and I'm not going to get into it tonight because it's outside the topic. But the TPO profile, in my view, is far superior to the volume profile. Well, guys, we have carried this considerably over an hour, but that's good. We've had some good questions. Hopefully you've gotten a lot out of this. I have recorded this. We're doing another of these, and the next one that we do in a couple of weeks is going to be sponsored by eSignal. And it's going to dovetail very nicely into what we did today. So you guys will be getting a notice on that. So one last round of questions. Anybody have anything else? Do I have any recorded webinars where you go into why you feel the TPO is superior? Yes, Dan, but I couldn't tell you what they are off the top of my head. which one it is, but I can do that. And again, Dan, stuff like this is covered in this 12-month training membership that we have. You guys, please, if you're serious about these techniques, this is an extraordinary opportunity. That's an incredible value. It really, 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 really is. So guys, if you want to contact us, here's the contact us. And you can email me at Tom. As a matter of fact, I think I have a slide. Hold on. Yeah, here we go. Okay, here is where you can reach us. Here's the website, www.alexandertrading.com. You can email me at tom@alexandertrading.com. And if you want to speak with us directly, the phone number 573-224-3366. I hope we will hear from all of you. Thank you again for coming.